A hedge fund used to be an investment firm that went long and short. If you're involved in a short sale, it means you're betting against a stock. You make money if the stock goes down.
Bloomberg is a data system that looks like a computer screen, but that clocks all the stocks in the market and keeps track of the trades on Wall Street.
Risk parity 4%, long-short equity 28%, credit arbitrage 6%, event-driven and risk arbitrage 24%, CTAs. I could go on, but it's all there.
Hello and welcome. I wanted to talk to you about investing and how to get started with it. It seems very complicated with a lot of jargon. In this video, I've cut through a lot of complexity and ended up with only 5 things you need to know to get started with investing. Follow these 5 things and you'll be ahead of 95% of all the investing experts with their decades of fancy education and experience. Let's start at the beginning. Investing involves committing money in order to earn a financial return. This essentially means that you invest money to make more money in future and achieve your financial goals. So in a larger sense, investing is about controlling your urge to buy stuff like shoes, a new phone, or spending money on eating out, and instead buying an asset that will make you more money in future, more than you have now. In the world of finance, these assets are shares or bonds of company, real estate, as in buying a house or a rental property, putting money in a bank, etc. You make money buying these assets in 2 ways: capital gains and income. Capital gains are an appreciation in the price of the asset. The stock prices increase, housing prices increase. These assets also generate cash. Stocks pay dividends, housing pays rental income, savings accounts and bonds pay interest income. But some of these assets don't generate any income at all. They only go up or down, generating a capital gain or a capital loss, like gold, Bitcoin, etc. There are also stocks that don't pay any dividends. Tesla, for instance. You could also have assets that don't generate any capital gains or losses, but only income. Bank saving accounts are a good example of this. Regardless of where you invest your money, you are essentially giving your money to a company, government, or other entity in the hope that they'll provide you with more money in the future. Investing is different from savings. If you were to keep your money under the mattress, you'd never have more money than what you've put away yourself. And that money will lose its value over time because of inflation. A gallon of gas used to cost 15 cents in 1915 in America. 107 years later, it now costs over $5. That is inflation. Even if you are not keen on growing your money, which you can do through investing, you should invest to beat the inflation, at least to maintain the purchasing power of your money. That depends on what exactly you're investing for and how long you're investing. If you have some spare cash lying around that you need to pay your rent next month, you should play very safe and put that money in a bank savings account. You should definitely not invest your rent money in stock markets. You probably know that stock prices move up and down a lot. What if the stocks you buy go down and you lose your money? You won't be able to make rent next month. But if you're saving money for your retirement in 30 years, you absolutely must invest in stocks for 2 reasons. First, you have enough time for stocks to recover, even if they crash, and they always recover, always, no exceptions. Second, stocks will give you the best returns among all the available options in the long term. I'll assume that most of my viewers are 18 to 35-year-olds who are interested in saving for the long term, so I'll focus on stock investing here. Stocks or shares are a tiny piece of a company that anyone can buy. When you buy a share and risk your capital, you are giving the company's management money to develop the business. In return, shareholders get the right to a slice of the profits the company makes. This money is paid as dividends, although most companies retain some of their residual revenue for investment purposes. Shareholders also have voting rights. Among other things, they can vote to elect the company's board of directors, who at least in theory are supposed to represent the interest of shareholders within the company. Shares are also known as equities. They can be traded in the public financial markets or held as private equity. Amazon, for instance, has a total of 10.17 billion shares outstanding. When you multiply the current share price of about $107 with shares outstanding, you get the total value of the company. That's the market capitalization, which is $1.15 trillion currently. Jeff Bezos owns a bit less than 10% of the company. That is about 10% of the total shares outstanding. When you buy Amazon shares, you are an owner of Amazon just like Jeff Bezos. The only difference is that you are a smaller owner of the company. Now that you know what stocks are, the next question is, which stock should you buy? Obviously those that will go up the most and generate the best return. But the problem is you don't know which stocks will go up. Which ones are the winners?
Nobody. I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi. You know what a fugazi is?
Amazon shares, for instance, jumped about 180,000% in the roughly 24 years from the stock's first closing since May 1997. Had you invested $100,000 in Amazon shares on 15th May 1997 and held on to them, they would now be worth $18 million. Holding on to them is important. We'll come back to that. I don't think anyone knew it would one day be so big. Maybe not even Jeff Bezos himself.
Well, I think all internet companies, the stocks are incredibly volatile. There are no guarantees. No guarantee that Amazon.com can be a successful company.
Amazon isn't even the top gainer among the 1,500 biggest listed companies in America since May 1997. That title goes to a company called Monster Beverages. Shares of this energy drink maker are up 330,000% during the time Amazon was public. Had you invested $10,000 in Monster Beverages instead of Amazon on May 15, 1997, you would have $33 million now. That's roughly 15.5 million or 87% more than buying Amazon stock on the day it went public. These are in fact the top 5 best performing stocks since May 1997. It's easy to say or wish you should have invested in these stocks in hindsight. No one can tell which stocks will do well in advance all the time. Not even the world's greatest stock investors like Warren Buffett. But many people try.
Stock pickers are having another dismal year. Now, twice a year, Morningstar publishes a report that measures the performance of U.S. active stock funds against their passive peers. So the latest conclusion, the same as before, stock pickers are still losing out against their passive brethren.
If you get it right, you'll make millions. But if you get it wrong, you'll lose all your money. So stock market is risky. You might have heard this from many people. Stock investing is also emotionally very hard. Here's why stock investing is emotionally hard. Amazon was listed at $9 in May 1997. It went to $600 by December 1999. Imagine the state of mind of someone who bought shares at IPO and is now sitting on a 6,500% gain. Put yourself in that position. How would you feel? Excited, of course. In addition to excitement, you would have felt one of these two emotions. Greed, hoping that it will go up further, but more likely you would have felt fear. What if stocks fall? It's better to take some chips off the table and collect the gains while you have them, right? If you sell these stocks at a 6,500% gain, you'll have a lot of money. You can buy a lot of nice things with this money. I can almost guarantee that you would not be in a calm state of mind unless you are some advanced yogi or something. And Amazon stocks did fall by 90% to about $60 from $600. Imagine how you would feel if you didn't sell at 600 and saw 90% of your gains evaporate. I mean, the sense of regret would be a lot to handle. Now, had you sold your shares after they fell by 90%, you would have locked in your losses and missed out on the rally of Amazon shares since then. The stocks went to over $3,700 in July 2021, from $60 to $3,700. As a stock investor, the ups and downs in stock prices is emotionally very taxing. This is why almost everyone who invests in stocks loses money.
Peter Lynch is here. He is a legendary investor. He is a best-selling author. He is a philanthropist. For 13 years, he ran Fidelity's Magellan Fund with average annual returns of nearly 30%. From 1977 to 1990, it grew from $18 million in assets to $14 billion in assets.
You would think investors in this fund would have done very well financially. But that did not happen. The average Magellan fund investor lost money when Peter Lynch ran the fund. How did this happen? It happened because we panic when times are tough and sell, and buy when the market is soaring. So we sell low and buy high. I can do a more detailed video on this if you like. Let me know in the comments below. The problem with investing in stocks is that first, you don't and you can't know who the winners are in advance. And even if you end up buying a winner due to some stroke of luck or genius, you cannot control the emotions caused by the ups and downs of the market, and you won't hold on to the stocks. So what do? There is a time-tested way to invest in stock markets. You won't have to pick winners, and you can reduce the volatility. Just buy all the stocks in the market, almost all of them. That's where index funds come into the picture. Index funds. Let's look at both the terms separately, index and funds. Index, according to the Oxford Dictionary, is an indicator, sign, or a measure of something. An index here measures how the stock market is doing on the whole. For example, the S&P 500 is an equity index that consolidates the stock prices of 500 of the largest publicly traded US companies. The S&P 500 makes it easy to understand whether the leading US stocks are gaining or declining in value. Fund, according to the Oxford Dictionary, is a sum of money saved or made available for a particular purpose. So an index fund tracking the S&P 500 index buys all the 500 stocks in the index in the same proportion as that of the index and attempts to match the overall performance of the S&P 500. Since index funds invest in hundreds or thousands of stocks, if a single stock in the collection is performing poorly, there's a good chance that another is performing well, which helps minimize your losses. By reducing the volatility that comes with stock investing, index funds are emotionally less taxing. Also, since you're investing in all the 500 stocks, you don't have to pick a winner. So index funds address both the problems of stock investing we saw earlier. All index funds have professional portfolio managers. What they don't have is the need to pay more for the expertise and time it takes to hand select stocks for each fund. This lowers the cost of managing the fund, and cost matters a lot. A mutual fund charges a total fee of about 2% or higher. By comparison, an index fund like Vanguard's VTSAX charges 0.04%. It might not seem like much of a cost reduction, but it is. It makes a huge difference over a long time because of compounding. Check out my video somewhere here about the power of compounding. Had you invested $10,000 per year between 2006 and 2020 in VTSAX with an expense ratio of 0.04%, these would be your numbers. VTSAX is Vanguard's total stock market index fund. Portfolio drag is the cash drag. It is the part of the portfolio that is held in cash rather than invested in the market. Had you invested the same amount in a 2% mutual fund, these would be your numbers. Even though the stock market is very volatile, the market always recovers, always. And if someday it really doesn't, because of a nuclear war or a deadly pandemic that kills everyone, no investment will be safe and none of this financial stuff will matter anyway. Not only does the stock market always recover, historically it has always been on an upward trajectory in the long term. It will continue to be. This is the closest thing you will ever have to a guarantee in the world of finance and investments. So invest in a low-cost index fund and don't bother about the ups and downs in the market. Before you start investing in anything, make sure you don't have any credit card debt. Do everything you can to erase that debt, because no investment you'll find will consistently outperform the 15 to 24% or so ARPs, annual percentage rates you are likely to pay on your credit card debt. Second, have an emergency fund for unexpected expenses. You could get laid off, fall sick, or there could be a natural disaster, or any of the other ways things could go wrong. The general advice is to have anywhere from 3 to 6 months of living expenses in savings account, should the unthinkable happen. You can invest that money in a safe, high-interest savings account that pays about 1% per year. If you're living with your parents and if they can support you in case of an emergency, you probably don't need an emergency fund of your own. Once you make sure you don't have credit card debt and have an emergency fund, invest whatever money you have. It does not matter how small it is. You know compounding is powerful and that inflation is continuously eating into your money's purchasing power like termites. So even if you only have small amounts, start investing as soon as you can. The best time to invest is obviously when the prices are low. But you don't know if the current prices are the lowest they can ever be or not. A simple and a time-tested solution to this problem is to invest a small amount periodically, which is usually every month. It's called dollar cost averaging and it establishes good investing habits and keeps you from missing opportunities. So even if you have a big amount to invest, don't wait for the market to fall. Break up that lump sum into small pieces and start investing every month. The dollar cost averaging will ensure that you don't lose out on cheap prices. You'll need a brokerage account and a bank account to start investing. It takes about 15 minutes and you're required to link the bank account to the brokerage account so you can easily transfer funds. Broadly speaking, there are 3 types of brokerage accounts: self-directed platforms, robo-advisors, and human brokers. Self-directed platforms include Robinhood, Webull, Vanguard, Fidelity, and many others. If you are in India, you have Zerodha, Upstocks, or Grow. For the most part, these platforms leave it up to you to figure out which investments are the best. But robo-advisors help manage your money. It's not fully self-directed. They use software to invest in low-cost index funds or funds of your choice. Say if you want to invest 70% in one index fund and 30% in another. They will do that and make sure these proportions are maintained by automatically rebalancing. You can set and forget. I think Betterment was the first robo-advisor, but Vanguard is the biggest now. In India, I think you have Kuvera, Tavaga, Market Mojo, and others. You know, previously banks used to provide personal financial services like portfolio rebalancing or tax optimization only to the rich. Now using software, robo-advisors provide these services to everyone. With human brokers, you have to call or send an email. It's also expensive, so it's best to stick with online brokerages, especially those that have robo-advising services. If you're saving for retirement, you should open what is known as a Roth IRA account if you're in the US. Its Canadian version is called TSFA, Tax Saving Financial Account. First check if you qualify for a Roth IRA or TSFA. If you do, you can select it as an option while opening a brokerage account. You still need a brokerage account. I made a video about Roth account. Check it out. Some of these brokerage accounts let you borrow money to invest. It's called margin trading. Stay away from that. Borrowing to invest in stocks is not a good idea. I hope that helps you get started with stock investing. This is Sharath Mantravadi. Thanks for watching.